Hope everyone's doing well. As always, none of this information is considered advice or things to do with your money or investing or trading. This is just my perspective and a collection of my thoughts. As I've said in the disclaimer, trading's risky, so seek professional advice. I got to make that very clear because I work for a broker-dealer and I'm registered with FINRA, so I have to make it clear that none of this is advice. So I'm not telling you what you should do. I'm just giving a simple, logical, both sides of the argument. Anyways, crude oil, always been a fascinating chart, crude oil futures. And one of the things that's interesting, and this just kind of highlights the channels. It's a bear channel, 3 pushes down. So bear breakout, second leg, third leg. Third leg clearly broke below this low here, second leg down. And what's fascinating is, I've said it for a while that I thought the odds were really high. I don't remember when I said it. Was it over here? I've talked about it. I always said the odds were high that we were going to go up to here, back into this range before we went extremely far. And one of the interesting things about that is you kind of have to be careful in terms of that's a very difficult trade management kind of trade. And what do I mean by that? Well, now again, mind you, this is a futures contract, and that's, if you were to technically hold a future into expiration, that gives you all sorts of problems. So I'm talking more of the conceptual idea of the chart, not the realistic, you're probably going to want to do that with some sort of ETF kind of thing, but this is more just the conceptual idea of the chart, not the market. It's more or less what's going on. So ignore that this is crude oil, pretend this is whatever stock you want, market you want, time frame you want. One of the issues is, we got a bear breakout, and look where it is, $9. So this is not a very, it's not a simple trade. And what I mean by that, and I hope I'm not confusing, is in theory, if you're trading a continuous chart, we saw in March crude oil went to negative prices. So just because with the futures market, if you're long and you say, I'll just hold to zero because it's not going to go to zero, well, that can happen. But needless to say, when you're crude oil is in a very interesting situation, because here we came really close to this breakout point. And with the strongest breakout we've had, an obvious break below a channel, the odds are we're going to test the top of the channel. And we can do that in a few ways. We can do it by going sideways. Top of the channel might be more like this. So the top of the channel might be $60. But it's very interesting. It's just a very interesting chart. How the further, so I don't want to spend too much time on it, and I'll talk more about it down the road, but strong enough, this kind of, strong enough breakout, odds are you were going to get a second leg. We went sideways for a long time again. Eventually, you're going to get a final flag is where I'm getting at. So any breakout's probably going to fail. And if we did this, we got a breakout. If we were to do that again, the odds would be that much more higher that the breakout would fail faster. So either way, just an interesting chart. I want to go ahead and discuss the S&P. This is this is Friday, January the 15th, 2021. So a couple of interesting things that happened. Bar 1, 20% chance it's the low of the day. I'm going to do it like this just because it's easier to explain my thoughts. Big gap down, bar 1, 20% chance it's the low of the day. 20% chance you get a trend from the open. So it's a reasonable buy, but it's not great. Probably better to wait for a stop and you're closing on its high. Bear bar, disappointment. So traders Not a great bar to buy above. If anything, just wait for consecutive bull bars. Do you want to call it a second entry buy? Not really. Starting to form a tight trading range. But if I do anything, I'd buy above, stop below. And it triggered, and we got that. So second entry short, it's, again, 20% chance it's low of the day. I would definitely get out of longs. I don't know if I'd go short. Double bottom here and here, second entry buy. Maybe 2 legs up, then pull back, second entry buy. Still, it's not a great buy, doji. Then we get a big bear bar. And then we get a big follow through bar. So definitely going lower at this point. But there's one issue. And the issue is, look at the moving average. It's all the way up here. Now, the faster we sell off, the faster the moving average is going to fall. However, at some point, the odds are the highest probability of the day we're going to touch the moving average. Therefore, we're going to touch it, whether the moving average gets down to here first and we touch it. But what does that tell me? That automatically tells me this second that we're not probably going to stay at this price for a while. Now, we could easily fall another bar or two. So buying the close of this is not simple at all, because if you're doing that, you really need to stop. Let's scrunch the chart up. You're going to need to stop somewhere down here. So it's not that simple. So if you're selling, you have to be aware. Odds are you'll get a small second leg down, but you got to be really careful because you could get a quick reversal. 50% of the moves on the open reverse. 50% of moves that appear to be major reverse on the open. Bull bar, not strong enough to probably erase this. Probably going to get at least a small second leg down. Let me do it like this because it's easier. Bear bar, that constitutes second leg down, so we have achieved the minimum. Another bear bar, and boom, we got a bull bar. So same thing, moving averages here. I would definitely get out of longs. I'd get out of shorts above this bar for the simple fact it's consecutive sell climaxes. We sold off pretty quickly on the open, and the fact that we're the moving average is very far away. We haven't touched it a while. We hadn't had a close above the moving average since here. So it's probably going to happen. So always in bears, maybe they sell this close, they get out above this bar, and probably stop below here. Strong bull bar, follow through bar. Reasonable chance this is the low of the day. But if you're buying, you need to stop down here, not in the middle. And here we go. So some traders will start getting out of longs, betting on a second leg down, and they'll buy the pullback, which is kind of what's going on here. So the market's deciding, do we test low? Do we get a 50% pullback, or do we go straight up? Okay, starting to get a 50% pullback, and here's a second, you can call it a pullback. I would not short here. This was too extreme. Odds are you're going to get a second leg up. If anything, if I got out of longs, reasonable to buy here, but stop down here. 3 consecutive bull bars, stop. You can probably move it down to here. Odds are we're probably going to get above this high, test the open. We may get above the high of the day. So not a strong, this is not going to be a great second entry short. Therefore, it's probably a better buy than a sell. And there we go. So we're starting to go higher. We've tested the open of the day. Now, another thing to note is this is a strong enough sell-off that it's going to be, think about what the daily chart looks like. So here's the open, here's the tail. So to really, if we close right here, it's a doji. To get a strong bull trend bar, we need to close fairly, well above the high of the day. So it's going to be very difficult for that to happen, which increases the chances of a doji and disappointment for the bulls. So bears, they sell. Bulls will sell to take profits on their longs at the open. Some bears will short at the open and scale in for a scalp. They made their money. Bulls, they know this is a strong enough buy the close rally or breakout that will probably get a second leg up. So bulls will buy more lower. But the stop's down here. We may easily get a pullback down to here because of the trading range. And boom. So again, bulls buy here. They're disappointed. Come on, Em. So like I was saying, we tested further than the bulls want. Second entry buy. Probably will test the close, but look what's happening. So it's not as strong as traders want it to be. And we finally tested the bull close. And look what happened. We couldn't even get a new high, so disappointed by the closed bulls. Scale in, get out a run break even. Triangle 1, 2, 3, 1, 2, 3. Not a great buy. Probably going to still go sideways. Strong enough bull breakout. You can probably move your stop down here or here. But again, breakout, disappointment, probably going to fail. Go back into this range. And, again, look where we are. We're not above. If this was going to be a strong bull trend, we would get a breakout and it wouldn't stall at major resistance. The high of this breakout, the start of this breakout, major resistance, high of the day. We would break above this and stall above it. We would not stall below it. It's kind of the whole thing of, if this is going to be a strong bear trend, we'd pull back, we would break to a new low of the day and then stall. We wouldn't start stalling here. So again, still going sideways. This can still channel up for a while, but it decreases the chances of a small pullback trend because bears are selling new highs and easily making money. So again, makes it difficult. You have kind of a wedge here, strong enough breakout, pullback, you'll probably test by the closed bulls. We'll be able to get out a break even. Very difficult to make money. You can see as soon as we got back to the high close, which was 76.50, price went to 76.75, so it went one tick above this follow-through bar and immediately sold off. And look what happened. So we're right back in the middle of this range. We'll probably test down to here. But wait, we didn't quite get there. So what happened right here? I thought we were going to test down to here. Well, again, it's a trading range. So it's selling off. It's going further than what traders want. Traders buy the close. They buy the low of this bar. And the stupid stop is here. The smart stop is somewhere down here. And so what bulls will do is they'll buy, and they'll buy at obvious support. So trading ranges are notorious for falling below obvious support levels or breaking above obvious resistance levels. One of those would be here. Or we have a breakout, we broke above a high. If it's a strong trend, we should not get below the high. Well, the high right here was 61.75. The low right here was 61.50. We went one tick below. So bulls sold here, scaled in, made money. Bulls that buy this low, what's going to happen? They're probably going to make money. Just like the bulls that bought this low are probably going to make money. Although this isn't a great buy, top of the trading range. If you bought the low at 74, price went to 75, you made money. So you buy, you scale in, get out. I'm not advocating any of that. And what I'm giving you is just perspective of what I think the computers and people that are trading in this time frame are doing. All these, if you haven't studied Al or you haven't studied, or, I'm not going to say studied me because I learned all this from Al. But if you think about it, a lot of what Al said makes sense. And, I'm just simply mentioning him to give him credit. I've never made a penny from him, so I'm not advocating him. This is just all my perspective from what I've learned from him. And if you think about it, markets are controlled by probabilities, math, so, risk, reward, and probability. If you're selling down here, everybody knows it's probably going to be a trading range after this. What they don't know is, where's the bottom? Is it here? Is it here? Is it here? So when you start to fall in the bottom range, traders start to buy and they start to scale in. Just as when we're starting to sell off, we start to test these highs, traders start to sell. They sold here. It only went a little bit above, sold off. It sold off for longer. So traders may say, okay, here's an obvious high. If I'm a bear, this is kind of what I was talking about with the trading range. Bear breakout, follow through. In a trend, you should be able to put your stop above this lower high, and it's not going to get stopped. You won't get stopped out. Well, if you're short, in a trading range, the opposite happens. price rallies and stops you out and immediately goes further down. My mouse appears like it just died. Goes further down. Yep, that may be the end of the mouse. Anyways, same thing here. Price went above, sold off. What are bulls going to do here? They're probably going to buy, and they're probably going to make money. But again, it goes further than what traders want. Tight channel, lots of bear bars, so bulls buying these lows. Look what happened. Not enough time for them to get out. So let's talk about that. Well, one of the things you got to be careful about is the later in the day, the more likely it is that you can get trapped. So if you're scaling in, you have a heavy position, it's easy to get in a bad situation. And the bulls that sold the close here, guess what happened? They got out at the end of the day. And last thing I'll say with this day, one thing I find really interesting is the more reasonable the buy the closed bar or sell the closed bar in this case, the more reasonable it is, the more likely and the more chances it'll probably get tested. What do I mean by that? Well, over here, is this a sell the closed bar? Sure, it is definitely. But it's, everything I said in the prior video, go back if you forgot it or want to hear it again. It's climactic. Is this sell the close? I don't know. If I had to do anything, I would probably consider buying the close rather than selling the close. And the reason for that is it's climactic, too far, too fast, far above the moving average. Bulls that bought here are probably going to make money. So it's kind of the opposite, but that's difficult management. I don't want to necessarily go into that. Therefore, I'm more confident that we're going to hang out at this price level, or if we rally, we may test this price level. But you can see how difficult that is. You sell this close, you stay long, you sell more here. Maybe you sell more right here. But what happened? You didn't get out. So bulls sell more here. If anything, I think what's more realistic is, well, I don't know. I don't want to go into that because really, realistically, if you're going to sell, you're probably going to get out above that bar. But in theory, you could sell. Traders will sell more, get out of break even, or they'll sell. They'll say, it's got to probably be a trading range, worst case, so I'll sell. I'll let it rally for a few hours. Maybe I'll sell here, anywhere in here, and get out back in entry. I wouldn't recommend that. There's just too much risk that you run out of time. So, hope this video helps. Oh yeah, well here first, let me do always in real quick. I didn't quite talk about that. So always in, maybe you buy above here, but you got to get out here. You can go short. I don't like to go short because I think we're going to test the moving average. But it is all, it's a reasonable short. No reason to get out. Outside down. Probably strong enough surprise that it's always in short. You could probably sell the close. Maybe sell and stop below, stop above. Big bear bar, probably move your stop above. Odds are strong enough you'll get a second leg down. Always in bears get out. All aggressive, always in bulls can buy. Not really a strong enough reason to get out here. Maybe you get out here, but if you do, it's still always in long. You got to look to buy again. Maybe you buy again above here. And, you can get out if you think it's a trading range. It's always in long. You can get out for any reason. Strong enough, if you've long, it's rallied far enough, you'll probably expect some sort of pullback and disappointment, but no reason to get out if you do. Maybe you buy again above this bar. Not very clear. And, do you get out here? You can. Maybe you get out below this bar. Maybe you get out below here. Bear bar, bull bar. Maybe you buy again above this bar. Stop down there or here. New high of the day. Probably better just take profits. You're well above the open of the day. So maybe you get out below this bar. I would not be very concerned with trying to go in and out because of context. So if you get out, maybe do you buy here? Probably not. Do you buy here? You can, but again, not all that great. And 4 consecutive bear bars, odds are the first reversal up's probably going to fail. But again, big bull bar, broke above the highs, immediately turned down. Is this strong enough bar you'll get a second leg? Maybe, but again, it's also a double top here, and it's also a micro double. So you can call it a nested double top here and here within a larger double top. So here's the first high, here's the second, and then here's the first, here's the second of the second high. Sold off, is it sell to close? You could argue, maybe it's sell to close with this many bear bars. Is it always in short? Maybe. So maybe you sell, stop above, outside down, but bad follow through, probably will at least get a small second leg down and sold off into the day. Hope this video helps.